So we spoke in part one about is just strengthening your master data governance, making sure your master data is clean. Let's go on to part two. So this will be part two of the series where we're talking about quality of processes. And Donovan, maybe you can give us another core area to improve quality.
Yeah, I think one of the key processes finance teams rely on to close their month end both timeously and making sure the data is accurate is the reconciliation process, and making sure those reconciliations are done accurately, making sure the reconciling items are cleared timeously post month end, but also making sure every account that needs a reconciliation is done and there's no 3-month, 4-month, 5-month lag. So that whole process around reconciliations can be quite daunting depending on your tech stack and your current management around the whole month end and reconciliation management specifically. Yeah.
So let's just step back. Let's try and understand, why do we even need reconciliations? Surely in a perfect world, there's no such thing. Why do you need a reconciliation if the supplier sends you an invoice, you pay the invoice, and you're done? That's it.
Yeah, I think following from what I said, is that invoice factual? Is it for the right amount that you ordered, from a quantity point of view, from a pricing point of view? If you're within a group, are they a group situation? Are they charging the right division? If they're a supplier that provides products throughout the group. So reconciliation between fact and is key, especially from and I'll throw another span in the works, is a cutoff. Your supplier cutoff might be the 15th of the month, and there's some transactions that happened after the 15th of the month, but you cut off for the 25th of the month. So in your creditors ledger, for example, that purchase order has come through, and that stock has come through, and you've receipted it. So it's in your ledger, but the statement for that month doesn't reflect it. So there's a timing cutoff. So there'll be always a need for reconciliation. In my view, Roger, nothing ever plans out in the perfect world, unfortunately.
Who has the right version of the truth? Is it the customer or the supplier?
So are you talking about both the external, from an external point of view?
Yeah, so when you're doing intercompanies, you say whoever the seller is in intercompanies,
Yeah.
if you're in a group.
Yeah.
So if there's a rental,
Yes.
the division charging the rent is normally correct, and the division buying the rent has normally got that timing difference. If it's accounts payable and accounts receivable, the entity that issued the invoice, they correct, and the entity giving the loan is normally correct versus the entity receiving the loan. That's kind of the rule of thumb.
Yeah, no, I agree.
Intercompany matching.
I agree.
How does that translate when you're dealing with external people? Or isn't there a rule like that?
No, I think typically, depending on your context and your cutoff and what your month-end rules would be, because typically, you're receiving a third-party documentation. It's viewed to be objective and something that you can corroborate, especially from an internal audit or external point of view. There's a third-party source documentation, and you're going to rely on that. So the onus is on you to then identify that or point out to your supplier that there's an issue. But in order to close the month end, here comes procedures and processes for closing month end insofar as creditors' recons are concerned. So typically, there's a threshold that's set according to your process documentation or policy document. Say, if you have X amount of percentage of threshold, process the invoice, especially when weight is concerned, right? Or if it's larger than that, beyond the threshold, then there's a separate approval process that happens. But even in mature organizations, that approval process is also automated via the ERP system. So to help from a timeliness point of view, from a cutoff and closing. So there are those rules when it comes to third parties as well. But the key thing is there's a process on how to deal with it so that the month end from a closure point of view doesn't not suffer. And then there's a process that then kicks on post month end is to review those reconciling items in terms of a timeline and make sure they are cleared. So whether your recon clerk then comes in to clear these things. So and in mature organizations, especially where these type of things are outsourced, there's KPIs for the recon clerk, etc., to make sure in a day you do X amount of recons or clear all these outstanding items. So in mature outsourced BPO type of finance organizations, you see those KPIs coming through to make sure that your whole recon process is sound and reliable. And yeah.
So I'm going to bring Anthony in here. We've got, this is the FP&AI podcast. Why are we talking about operational transactional reconciliations here? How do reconciliations impact your reporting and your planning and your KPIs, your communication?
First of all, from a reporting point of view, you want to make sure you're reporting accurate information and making sure that information's reconned and checked contributes to that, so that when you reporting at your month end, you are reporting the truth of what's happened in the business. You're not just accepting that it's correct. From a planning point of view and from a strategic planning point of view, as an example, it can have quite a big impact. So let's take if you go into the context of like cash forecast planning, your recon of your cash balances is essential and critical to the accuracy of the cash forecast going forward. So you need to make sure that the bank balances recon to what your balance sheet is saying, so that your starting point of any cash forecast is correct. Otherwise, you could make some very wrong decisions in the next days, weeks, even months, because of that inaccuracy that affects your business in a very negative way. You might have too much cash, which is not beneficial necessarily, but you might have too little cash, which means you can't actually pay your creditors, and that obviously creates a major issue. So that's an example where, from a planning point of view, it becomes quite essential in terms of making sure you're making good decisions in your business, even in the short term. For example, your cash flow forecasting.
Good. Okay, back to Donovan then. So how can a company improve this reconciliation process? Give me some steps that we could follow.
Yeah. Okay. If you don't mind, Raj, I'm going to just show share an image with you. Yeah. So yeah.
Is that you? Is that you in the middle there?
It used to be me. Fortunately, I'm now part of FP&AI. Yeah.
So there was complexity, manual work, volume, no oversight. That's all resting on your back.
Yeah, and it's a burden for finance, and this represents finance. You know what your accounting records needs to be, and that's my truth that you're alluding to, and this is what you have control over. But sometimes we saddle with, you have different disparate systems, your processes are not complete, and you have people internally, for example, creditors, debtors, not following your processes. But there's the third party.
So sorry, are you saying there that even internally my truth might be out?
Correct.
So before we worry about suppliers and customers and government agencies, we're saying our own processes and modules within our ERP system
be incomplete,
could have problems.
Yeah. I mean, bank statements not fully uploaded or captured. You might not have a third-party receipt from a customer or payment reflecting. So you'll throw your recons out. So that's a typical example that may come to light. And there's the other truth, which is the external or internal, outside of finance, that we are talking about. I mean, there's different cutoffs from your suppliers in terms of subsystems. For example, your commercial team might be using HubSpot or another CRM, and that may be working, to bring your pipeline or your orders in. So there's disparate systems or things that you don't have control of that will have another truth, and we need to bring them together to understand what the true reconciling items is. And this has a massive burden on the entire finance function internally and externally. And we won't go into much detail. This is from our Recon slide pack that we take our customers through typically. But this is what we want to see: a digitized a Recon environment where you have your truth, all right? You have the other truth that you don't have any control over, but in between, you've now built a bridge. You're no more hanging in the balance. You empowered and no longer burdened, and you have a clear lens to the truth. And what supports that is you have an enabling technology, ERP, for example. Your processes are standardized across the group, across the accounts, across divisions. You've automated data collection where you can, especially with third-party suppliers or customers. Through data exchanges, for example, especially, for example, transporters, EDIs, for example, you've got that. You've used AI technologies. We've seen that, for example, with Profix, where it can auto-match data coming in and eliminate the time spent on reconciling items. And then you can then focus on the outliers from a quantity point of view and the number of outliers. And that's where you record adjustments with the use of RPA processes. And that,
Or humans, if you don't have that.
pardon?
Or people. Otherwise, it's people.
Or people. If that was there. So this is obviously a full maturity type of implementation, but you start somewhere and you look at what your as is and you get to that maturity one block at a time. But definitely, and if need be, we can give some practical examples out there, maybe in another session with the audience. Practical examples where we've seen the as is, what it was, and what we're able to implement and bring that recon risk right down. Yeah.
So when that first block, the implement enabling technology, three things come to mind. The one is, can your ERP system automatically do those recons? Because some of them can.
Yeah.
Sometimes when you've got disparate systems or your ERP can't do that, we're talking about bringing a third-party application in there as the enabling technology. It's the Recon technology, or you're going to go back to Excel. If you don't have one of those first two, probably you would have to have a whole series of Excel spreadsheets, and then one has to think about the standardized Recon process. Are you standardized then if everyone can adjust that spreadsheet the way they want, or maybe you've locked it down?
Yeah.
But that makes sense. Is that right? Am I reading that?
Yeah.
Correct?
And if you're still in an Excel environment, that's not the end of the world, because at previous organizations, we implemented standardized Excel templates that were then uploaded into the ERP system to support the adjusting journal entry. And those were PDF'd, those were then signed by the person capturing, the person approving, the person that prepared the recon, the person that approved the recon. The supporting documentation is all there for the opening balance, the closing balance, the reconciling item. So one can still go the sort of manual route with Excel and bring that standardization. We had a recon register, and someone monitored to make sure, is this account done, that done, looked at, when last did you do the recon, etc. And even for example, an 80-20 principle, where if 20% of your suppliers was 80% of the creditor's balance, because sometimes you could have hundreds of suppliers and you just don't have the manpower to complete all those recons. So there are ways, but what we're trying to bring across is that standardized recon process and managing that.
And then if you've got the stack in place, you've obviously got the visibility as these recons are happening. You've got the numbers. How many recons have we done?
Yeah.
How many are standing? What is the total adjustments? What matched? What didn't match? You've got that full picture across your whole entity. That's the beauty of this.
And what's good with the technology, it'll flesh out these outliers as well. It'll look for recurring entries, but suspicious entries, it will kick that off as well. Some of the technologies do flesh out or identify or ring fence these non-routine transactions as it's identified, where one can pick up potential risk entries. Yeah.
And Donovan, is that you in the middle there again, jumping up? You've got to be careful you don't fall over the bridge.
That's me
It's like you're up in the air.
walking on air.
Walking on air. Well, that's pretty cool.
Yeah.
Thanks for that picture. So let's wrap this session up. So we're reminding ourselves that we talked about the quality of data and controls. And we said in our first episode, or part one, we spoke about standardizing master data, making sure that that's solid. In this part two, we spoke about enforcing reconciliation discipline. And is there anything you'd like to add to that in closing there?
Yeah, I think just to, again, kind of in summary, and I think, it's a important link in the two is you've got to have, those are two pillars. There's more that we can probably talk about, but the one supports the other. If your master data is in a good space, it means that your recons you can rely on in a good space. You reconning the right customer against the right record in your ERP. So it all starts coming together as you get these disciplines in place, and that quality will be better, but also sustainable within your organization.
Right, so that's the end of part two on quality data controls, quality of data and controls.